maybe we could just move forward to some of your thoughts on the market this year. I think you've described the market as feels like we've been through maybe three different markets so far this year. Maybe you can give us an idea of what the portfolio looked like prior at the beginning of the year, January, February, how it looked during the drawdown, if you made any changes kind of post March. What did you do and why did you make changes?
Well, I would say that we've been through three or four markets since the beginning of the year. When I thought it was impossible to do better than last year, we were up, 42%, and we had a couple of 30 and 40-year numbers before that. So we took a lot of growth assets and thought about what was going to be successful going forward. But pre-COVID was very much like now, with growth and momentum far outstripping value names.
Right.
At the same time, there were concerns about China versus U.S. trade dominating. And we thought straight up winners like Apple and Microsoft, like now, were probably ahead of themselves. And we started trimming winners at the same time we were expelling losers from the portfolio. So back when the market was making new highs in January and February, we were taking profits in financials and reducing, anything or anything that was energy related. But it rolled over pretty quick from February to March, and in March, we actually started buying too early. A lot of, like, the buildings products companies and other cyclicals took a dive and were down 40 or 50% in 2 weeks. And we thought they'd do okay despite a couple of quarters of COVID. I don't know if you remember back in March when we met to review last time, just before the lockdown, I told you I expected a V-shaped recovery and was positioning for it. And we were buying every day, and I think the market bottomed within a week of that meeting. And we added some great exposures down there that positioned us completely for the recovery. Both very cyclical names, like I just mentioned, and also the big growth names. We were buying like the Cienas and the Marvels, the 5G guys, because we thought it was going to be at least a year before earnings would come back, and we wanted to be, sort of hiding out in 5G because nobody was expecting 5G to come on until late 2021 or beginning of 2022. So we looked out with getting into some of those names. We also bought some changing company names, companies like Elanco, which is the pet food business, and HD Supply, which is the company that supplies all of not only Home Depot stores, but also their competitors with, do-it-yourself and contractor supplies for everything from tile to, lumber. But back in June, we saw another change in the market, and maybe we sold a little too early, with many of those more cyclical names doubling from the bottom. But we thought that they had probably gone too far too fast, and we were looking to get into names that were not as cyclically exposed. And we also continued to trim the high flyers like Microsoft and Ciena. Fortunately for us, in the case of Ciena, because after Cisco disappointed and warned on enterprise spending in middle of August, on their earnings call, and the stock cratered, we got a feeling that things could get rough for tech companies going into the fall as spending, flatlines with fewer folks going back to the office, and enterprise budgets probably being trimmed. We had originally swapped out of Cisco into Ciena a couple of years ago to get that higher growth from the smaller company. And it ends up just goes pretty much flat after 3 years. It's back to where it was when we sold it.